Let's kickstart the show with the first corporate, and that is MapmyIndia. Now, this is a company which is a digital maps provider, but unlike Google Maps, which is a B2C player, we use it on our phones. MapmyIndia is predominantly B2B. Enterprises use it. So many of your, the Swiggies and Zomatos, I'm not naming their exact lines, but they would use it to reach your location to deliver your parcel. Now, we're talking about their Q3 numbers. Now, revenues are very strong on a year-on-year basis, but on a quarter-on-quarter basis, it has dropped by 11%. EBITDA margin too was higher this quarter, aided by lower marketing expenses. Rohan Verma, the CEO and Executive Director of MapmyIndia, is now with us on the show to discuss numbers and the way forward. Rohan, morning, and thanks for joining in. This is Rima here. First, could you explain that quarter-on-quarter drop in revenues?
Hi, Rima. Thanks for having me on your show. Q1 and Q3 seasonally typically are lower for MapmyIndia, given the sort of cycle. So I think it's just a reflection of that. Year to date, year on year is the best metric to measure MapmyIndia's performance. And on that, as you can see, it's doing quite well. And even year on year for the quarter, it's done quite well.
What about the consumer tech and digital enterprises? That's 40% of your revenues. And here you would cater to a lot of startups. And startups have been under pressure. Funding is dried up for them. Any customers of yours, any clients which have shut down or curtailed their operations, they've reduced the kind of work that they were giving from you, because you also operate on a model where you charge per usage, on a charge per use and not a flat model. So could you tell us if any clients are under stress or any signs of slowdown?
If I look at it from a portfolio point of view, Rima, the number of use cases that we have, the number of customers that we have on the C&E side is quite diversified. And, some of the larger players like Amazon, Flipkart, they're all doing quite well. And they are part of our portfolio of customers. I'm sure there are small customers here and there who are suffering due to these funding crunches. And we have seen a few small, health tech like startups, etc., who have kind of, gone by the wayside. But overall, I think very, very nice to see, companies which are on strong fundamentals do quite well. And beyond the consumer tech, the enterprise sector, be it the traditional businesses like FMCG, like retail, like infrastructure companies, and even the public sector under the government, which all fall under C&E sector, are doing quite well. So, it's actually quite a good time for us that more use cases and more usage of our products and solutions are happening.
Rohan, if I look at your revenue breakup, auto contributed about 40 odd crores, and this consumer tech and enterprise, this contributed a little over 27 crores. Given what you just described, as you're looking at the next financial year now, tell us how both of these will move ahead, and also a little bit about the margin profile on both sides. Where will you be making better margins in FY24?
Sure. So A&M versus C&E both have very similar margin profiles, because essentially we license or provide subscriptions to our maps, our APIs, and our software. So what we call PaaS, platform as a service, maps as a service, and software as a service. So in terms of margin profiles, both are similar. I think if you look at our track record and even this quarter, EBITDA margins are in the 35 to 45% range. I think year to date we are at about 42.5%, and PAT margins are in the 30 to 35% range. I think year to date we might be 32, 33%. And really the contribution also is roughly split half and half. There are different growth drivers for A&M for us, whether it's new vehicles which are adopting more and more connected vehicle technology, or existing vehicles on the road or fleets on the road which need to digitize for improving logistics efficiency. So that's A&M. And C&E really, as more and more consumer apps get used by consumers, or more and more enterprises are trying to digitally transform, the value and usage of maps and geospatial technology, and even now drones, which is a sector that we are going deep into, is only expanding.
Just a very quick question on auto. Help us understand how this huge move on EVs, I mean, every auto company worth its salt has, massive plans and launches lined up. To what extent do you see that sort of, benefiting your business? Can there be a marked improvement in the auto business in FY24 because of this?
Yeah, we're really benefiting from this move towards EV, because when it comes to EVs, range anxiety is quite a question on people's mind. And navigation, which is based on informing you whether you'll be able to reach your destination with battery in hand, or what is the most battery efficient route you can take to your destination, as well as what is the health and SOC and predictive maintenance of the batteries or the electric powertrain based on the telematics we provide, are all becoming quite important, or charge station locations and being able to reserve and book charge stations. These are all part of our suite of N-case navigation-enabled, connected, ADAS, shared and electric solutions. So, and you've seen a lot of new EV OEMs sign up with us. Even just this past quarter, one of the larger foreign entrants in the EV four-wheeler space has signed up with us. And on the two-wheeler side, bunch of EV two-wheeler startups have signed up with us. So we are set to benefit from this move towards EV, because EVs by definition need more technology, and that's what N-Case from MapmyIndia provides.
Okay, Rohan, then would you give us some sense on what the entire order book is looking like? I mean, the last time we spoke to you, it was around 700 crores. You are saying that a lot of these EV players have come on board and have signed up with you. Could you give us some sense of what it's looked like? How much has it picked up?
Yeah, the momentum is strong on new order wins. I think we talked about in Q3 wins across automotive, logistics, consumer tech, and enterprise and private and public sector with a lot of different use cases. We started the year with 699 crores as an order book, and we'll declare the open order book at the end of Q4. It's an annual figure, and as you can imagine, Q4 is where a lot of orders get bunched up. But momentum so far is very good. We're very pleased with progress so far, and just 3 more months and we'll declare the annual new order bookings and open order book.
Okay, we will wait for that till you declare the full order book. But just one final question on the margins. You were mentioning that 9 months is up. I mean, it's currently at around 42.5. This is higher than what you have been doing of 35 to 40. So is this going to be the new normal? Can we expect above 40% kind of margins going forward?
Actually, I think our guidance is, or just generally the way that we want to structure our business is, we are lucky that we are a digital products and platforms company with high kind of contribution margins, EBITDA margins, PAT margins. And so the trade-off between profitability and growth is not a zero sum. We want to calibrate our revenue growth in that 30-40% range while maintaining these EBITDAs and PAT margins holistically for the whole company in the 35 to 45 EBITDA and 30 to 35 PAT. So overall, this is a pretty strong kind of financial picture we would like to draw for ourselves. And so we leverage the growth that we see in margins to calibrate our marketing expenses, which has a knock-on effect on future growth of the company. So I think we'd like to stay in this range, and that can only mean stronger future medium-term growth for the company.
You're saying your margin guidance is now 35 to 45%? That's the range?
In EBITDA, yes. And in PAT, it's 30.
Okay. Last time you told us 35 to 40%, so you are increasing the upper end of the margin guidance.
I mean, ideally, I'd like to stay conservative, but as you see, the numbers are 42.5% right now. So we'd like to stay conservative because we want to maintain the ability to invest in future growth.
Rohan, we'll leave it at that. Thank you very much for joining in. That's CE Info, known as MapmyIndia. And you were just talking about electric vehicles, and here the opportunity is battery efficient route planning. You also want to know where is the closest next charging station. You want to calculate the range before you hit the next charging station. In e-commerce and food delivery, it's last mile delivery to reach your exact hotel. In healthcare and pharma, it's the GPS tracking of ambulances. In logistics, it's fleet and asset tracking, and of course route optimization. In the telecom space, you're using it for optic fiber mapping. So the enterprise use cases are so many for a company like MapmyIndia, and it's only expanding because the company is now saying maps for two-wheelers are now being offered, and that's also perhaps a potential opportunity for the company. We'll get into a break. On the other side, we'll discuss commodities. Manisha Gupta joins us next.